if you're listening to this, you've definitely seen it, the extreme highs and the terrifying lows of the crypto market.
Oh, absolutely. And that gut-wrenching volatility is exactly why everyone from, the weekend trader to the seasoned pro is looking for a shortcut.
The ultimate cheat sheet, the thing that promises to beat the market.
It's that basic human desire for an edge, right? And that desire has fueled a massive industry built on telling you exactly when to buy and when to sell. But can these expert predictions really cut through all the noise? Or is the simple buy and hold strategy still king?
That is the mission of this deep dive. We are unpacking two completely conflicting narratives. On one side, you have the popular high claim world of Telegram crypto signal groups, the hype machine.
And on the other, we have recent, really rigorous academic evidence that tests the very tools those groups rely on technical indicators.
Yeah, we've waded through the promotional materials of over 20 of the top crypto signal groups. We've noted their, let's say, bold claims of near perfect accuracy.
And we're putting them directly against a comprehensive 2024 academic study from the Journal of Derivatives and Quantitative Studies. This thing tested popular indicators on 99 different cryptocurrencies.
So our goal is to give you the facts. Do these technical trading rules actually generate statistically significant returns in today's crypto market? Let's dive right in, starting with the lure of that instant alert.
Telegram has really cemented its place as the go-to hub for crypto signals.
Yeah, why is that? Why Telegram specifically?
It's all about speed. It supports real-time, instantaneous updates, and its format just lets these crypto communities grow into the hundreds of thousands. It's perfect for getting an immediate alert when a trading window opens up.
And for the part-time trader, the value proposition they're selling is, it's incredibly compelling.
Of course. They promise to save you time because, professionals are filtering the markets for you.
They offer real-time alerts, which are absolutely crucial in a market that can swing 10% in like 5 minutes, and they claim you're getting access to expert insight.
Right, based on years of technical analysis. And to be fair, many groups do stress an educational component. They'll explain the charts and the reasoning behind a trade, which, can help a new trader learn the language.
But let's talk about the claims, because this is where the skeptical alarm bells really start ringing. We're talking about groups like Crypto Ninjas claiming a success rate of over 90%. Binance Killers pushes that to around 92%.
And then you get into some truly audacious claims. We saw WolfX Signals claiming just a bold 98% accuracy. Wall Street Queen Official was claiming around 96%.
Okay, wait, 98% accuracy.
And we have to pause there because these high figures are almost always unverified. There's very little transparency about their methodology or the sample size or how long they've been tracking this.
If even half of that were consistently true, wouldn't the crypto market be completely broken?
Yeah.
If one person or one group had a 98% predictive edge,
they wouldn't be selling signals on Telegram.
No. They'd be running a multi-billion-dollar hedge fund in total secrecy. How does that level of confidence even exist in their marketing?
It exists because they are marketing to a highly emotional audience in a highly emotional market. They sell the dream. But here's the nuance. A signal can be correct in that the price moved in the right direction, but if the entry point was bad or the risk to reward was terrible, it still wasn't a profitable trade.
So it's not a magic key.
Not at all. These are indicators, and you have to approach them with extreme caution.
That sets us up perfectly for the next part. If these claims are based on technical indicators, we have to understand the tools. Let's start with the foundation. Moving averages.
Moving averages, or MAs, are really the core concept. Their whole job is to smooth out the daily, sometimes hourly, price chaos to help you see the underlying trend. They're designed to filter out the market noise.
And their usefulness really depends on their sensitivity. So the classic kind of slow tool is the simple moving average, or SMA.
The SMA is the workhorse. It calculates a simple arithmetic mean, so it gives equal weight to every single data point in its period.
Which means it lags behind the current price a bit.
A lot sometimes. But that makes it fantastic for identifying those big, long-term trends. Think of like a 200-day SMA defining a market's health over months.
But if you're trading crypto day to day, that's way too slow. You need speed, and that's where the exponential moving average, the EMA, comes in.
Precisely. The EMA is the modern choice because it places significantly greater weight on the most recent prices. It kind of throws shade at old data, making it much more reactive.
More timely.
Exactly. That's why short-term traders love combinations like the 8 and 20-day EMAs to spot immediate shifts in momentum. The goal is just to reduce that lag.
But the best signal groups claim they're using stuff that's even faster, something that reacts not just to time, but to volatility. Which brings us to the real heavy hitter, the variable moving average, or VMA.
The VMA is basically the race car of moving averages. Standard MAs have a fixed smoothing weight. The VMA is designed to automatically adjust that weight based on what the market is doing right now.
So it speeds up when things get crazy.
Yep. When the market's quiet, it smooths heavily. When the market explodes in volatility, it makes itself more sensitive to catch the move.
So what's the engine driving that adjustment?
It uses something called the Shanday Momentum Oscillator, or CMO. The CMO measures market momentum, and that reading dynamically adjusts the VMA's smoothing factor. So if the CMO shows strong momentum, the VMA becomes highly responsive.
That sounds perfect for crypto, but what's the downside to all that speed?
The trade-off is stability. In an ultra-volatile market, which, crypto is, that dynamic adjustment can become too sensitive. It can create excessive and potentially false trading signals. You get whipsawed.
So now we understand the tools. Let's look at the specific indicators that the academic study actually put to the test. They didn't just look at averages, right?
No, they looked at 5 indicators that are really the foundation of any technical trader's toolkit. Let's start with the parabolic stop and reverse, or SAW.
SAR. That one's all about trend following.
Right. It uses a trailing stop level. The assumption is you're always in the market, either long or short, and it tries to spot reversals when the price flips that SAR line.
Okay, next up is the big one. The moving average, convergence, divergence. MACD.
Your roadmap indicator. It uses 2 different EMAs to spot changes in strength, direction, momentum. It's famous for signals like the golden cross and dead cross when its lines cross over.
Then moving from trend to just pure momentum, we have the relative strength index, the RSI.
Think of RSI as the market speedometer. It evaluates how strong a price move is, tracking how fast the price is moving up or down.
And that's where you get the classic overbought or oversold conditions.
Exactly. Typically above 70 for overbought, below 30 for oversold, suggesting a correction might be coming.
But price isn't everything. You need volume. And that's where the money flow index, or MFI, comes in.
Right. The MFI is basically the volume-weighted version of the RSI.
It's like the check engine light that tells you if the momentum you see on the RSI has real weight behind it.
Perfectly put. It reflects buying and selling pressure based on trading volume, not just price. If RSI is high but MFI is low, that signal might be weak.
And the last one they tested.
The Commodity Channel Index, or CCI. It basically quantifies how far the current price has strayed from its moving average. When it crosses way above 0, that's strong buying momentum. Way below is downward pressure.
Okay, so we've covered the hype, we've covered the complex tools. Now let's get to the acid test, the academic verdict.
And the core question this study tackles is whether crypto markets follow the idea of weak form efficiency.
Which, in simple terms, means that if the market is efficient, then using past price history to predict the future shouldn't work. Technical analysis is basically invalidated.
Exactly, and the researchers were incredibly rigorous. They used data from Binance, covering 99 cryptos with at least a year of history, all the way up to 2021. And they compared the 10-day returns from these technical strategies against just buying and holding.
Okay, the baseline. What was the average return for someone who just bought these 99 cryptos and held them for 10 days?
The overall average buy and hold return was 0.0265. That's our benchmark.
Got it.
So their first big finding was about single indicators. Across the board, strategies using a single technical indicator generally resulted in returns that were lower than that simple buy and hold average.
That is genuinely shocking. You have all this complexity, EMAs, RSI, SAR, and on average, they failed to keep up with just buying the asset and ignoring it for a week and a half.
There was one little bright spot. On the long side, the MACD strategy did have the highest average return at 0.0589. But, and this is the important part, they didn't just stop at the average. They checked for statistical significance.
Meaning, did it outperform in a way that couldn't just be random chance?
Precisely. And what was the answer?
I'm almost afraid to ask.
Only 3. Out of all 99 cryptocurrencies, only 3 showed returns that were statistically significant at the 5% confidence level.
3 out of 99.
3. For the other 96, the returns were, statistically speaking, no different from just holding the coin.
So if you're relying on a single indicator, you basically have a 3% chance that it's actually giving you a persistence, non-random edge. That is a powerful argument for weak form efficiency. What about short selling?
Oh, that was even worse. The study said short selling strategies showed much worse results than buy and hold. They were just not reliable for spotting profitable shorts.
Okay, so single indicators fail, but what about combining them? Using one to confirm the other. They tested that, right?
They did. They tested 40 different combinations, like using SAR as the main signal and MANCD as a confirmation. And the returns were slightly higher than single indicators in some cases. Combining them did a better job of filtering out some bad trades.
But was it enough? Did they finally generate that statistically significant outperformance?
No. The researchers concluded that even strategies using 2 technical indicators did not generate abnormal returns. The sophisticated strategies were just as likely to be explained by random chance as the simple ones.
So if we pull back to the big picture, the ironclad conclusion from this 2024 study is it's pretty profound.
It strongly suggests that cryptocurrency markets are, in general, weak form efficient. Technical trading strategies, even complex ones, do not generate returns that are statistically different from a simple passive buy and hold strategy.
And here is the truly vital, almost devastating note that has to sink in for you, the listener, especially if you rely on automated trading bots. The returns we just discussed, they excluded transaction costs.
Correct. Technical trading means frequent buying and selling. The researchers explicitly noted that if you include exchange fees, gas fees, and commissions, the returns of these trading strategies would be even worse.
Wait, so this study concludes that technical trading doesn't work, and then adds a giant asterisk saying, by the way, if we factor in the fees you actually pay, the performance would be seriously negative.
That's the implication.
So a strategy that already fails to outperform just holding becomes a guaranteed net loss in the real world. That has to change your perspective on trading bots built only on technicals.
It absolutely has to. And this is the reconciliation challenge for you. On one side, you've got signal groups promising 90+% accuracy with these tools.
And on the other, you have hard data saying these tools, in general, fail to beat doing nothing and actively lose you money once you factor in costs.
So why the disconnect? Well, those 90% claims might relate to a few cherry-picked trades or a very specific time period, but they fail the scientific test of generating persistent, verified outperformance over a passive baseline.
So what does this all mean for someone using these signals today?
It means you have to recognize them for what they are. They're inputs, not outputs. They're indicators, not guarantees.
Your key takeaway here is that the signal, that alert from Crypto Ninjas, it must be combined with your own research and, most crucially, with strong risk management.
Yes. If the signal is wrong, if the indicator fails, you have to have an exit plan. And this is one area where even the promotional materials from the signal groups agree. They all stress risk management.
Which means using tools like the stop-loss order. This is your safety exit. It automatically sells your position if the price moves against you. If you are risking more than, say, 1 or 2% of your total portfolio on any single trade, you're relying on luck, not strategy.
So in this deep dive, we've dissected the mechanics of dynamic indicators like the VMA, which adapts to volatility. We've seen the confidence of the Telegram signal market with its bold, high accuracy claims.
But the rigorous data provides that crucial reality check. Recent academic evidence, spanning 99 cryptocurrencies, strongly suggests technical trading rules do not generate returns that are statistically superior to a simple buy and hold strategy, especially after costs.
So given that technical indicators alone can't seem to consistently beat the market, and knowing that their effectiveness has historically faded as markets mature, something called the adaptive market hypothesis. What combination of technical analysis and maybe fundamental project analysis might be necessary to find a true persistent edge in this perpetually evolving crypto landscape?
That's something for you to explore as you decide how you want to approach this volatile, fascinating market.
Until the next deep dive, stay informed and manage your risk carefully.